don't allow the reading and learning to take over the doing, because you still need to invest in real estate and need to actually apply what you're learning in theory, apply it to practice. Because if you don't do that, and so many people on Bigger Pockets, they talk a lot about real estate. They know a lot about real estate theory, but they haven't done a single thing, and they don't know how reality works. Are you a young person considering investing in real estate? Maybe you're still in school, but you heard about how real estate can make you wealthy over time and you're eager to get started. Well, if you are, you probably have a lot of questions. In this episode of the Succeed REI podcast, I spoke with an aspiring investor who is graduating high school and starting college this year. He's very motivated to get started as soon as possible, and he had a ton of questions for me. We spoke for an hour and a half and went in depth into a variety of topics relating to getting started in real estate without much capital or experience. We covered everything from house hacking to seller financing to using cosigners in private and hard money lenders. We also talked about the best side hustles and jobs to take while in college to help further the ultimate goal of buying and owning real estate, and much, much more. This was an awesome conversation, and I think that both new and aspiring investors can take a lot away from watching this episode all the way through. But hey, if we're just meeting, my name is Vitaly Volpov. I've been investing in real estate since 2011. I currently own over 160 rental units, a real estate brokerage, and a property management company in upstate New York. Real estate has allowed me to leave my demanding corporate attorney job in 2020, and I've been living semi-passively off my rental and business income ever since. Today, I help new and aspiring investors reach financial independence through real estate investing. If you find this video helpful, please leave a like and subscribe. And if you want to connect with me further, feel free to join my free private house hack mastery group over at school.com. The link is in the description below. Now let's get into the video. All right, Taylor, welcome to the show. Welcome to the YouTube channel. How are you doing today?
I'm doing great. Thank you. It's awesome to be here.
Yeah, it's a pleasure talking to you as well. So before we dive into the questions that you have for this coaching call, if you can just tell people a little bit about yourself, how old are you? What are you doing? And what is your interest in real estate right now?
My name is Taylor. I'm 18. I live in Dallas, Texas. I am going to go to college next year. I'm a senior this year. I'm looking at either Baylor, SMU, or A&M. And this past month or so, I've found interest in real estate. Been reading a bunch of books, talking on Bigger Pockets, met Vitaly, and he took time to talk to me. So I'm going to ask a couple questions. I've been looking into like the multifamily side. And since I'm only 18, trying to figure out how to fund stuff for real estate.
So it sounds like funding is like the biggest obstacle for you right now, as it obviously would be being at your age and not having an actual income. So why don't we go ahead and jump into the first question that you want to dive deeper into?
Yeah, okay. I was wondering, how can someone my age go about obtaining private investments from real estate, like entrepreneurs and stuff like that?
Yeah, so private lenders are pretty hard, man. Just in general, when you're talking about strangers and people you don't know, people who don't know you, to get them to invest in you and fund your real estate ventures, I think it's going to be pretty hard. And I think that the first line of attack really for you, honestly, should be people you already know. And so it'll be people in your circle, your friends, your relatives. And I'm just going to throw up on the screen just so that everyone can see breakdown of what I'm talking about. So when it comes to private lenders, these are people that need to know, like, and trust you. And this goes across the board, whether you're talking to people unrelated to you, business associates. So I'll give you a little bit of a kind of my background and my take on this. I think about probably like 95% of the real estate that I've purchased since I started investing has been using private lenders. And it's not something that is necessarily easy or natural, but there are a lot of benefits with it, that if you can get those private lenders, if you can find those people to invest in you, then it'll allow you to scale. If you're looking to buy rental properties, it'll allow you to scale your rental portfolio a lot quicker. If you're looking to flip houses or do some other endeavors that require financing, then it'll be, the same effect as well. But the biggest obstacle for you right now is that you don't really have any experience. Right? You don't
Yes,
have
sir.
any experience. You don't have a job right now, at least not a job that I'm sure can repay someone hundreds of thousands of
Definitely,
dollars
definitely.
if they were going to lend to you, right? So I think the first line of attack for you, if you want to go this route, and we'll talk about some other routes as well, but just strictly talking about private lenders, I think you need to reach out to friends and family, specifically family first. So anybody, obviously parents, grandparents, aunts and uncles, anybody who is possibly nearing retirement or close to retirement, or they have some funds. What a lot of those people have are various retirement vehicles where the money, or even savings accounts, right? Where the money that they have there might not be earning them the interest that they would like. Maybe they had or do have some interest in real estate, but they don't want to put in the work and the hustle and the time that it takes to actually learn how to do it right, do it successfully, and all of that. So the thing you'd be approaching them with would be saying, hey, I'm really interested in real estate. I've been learning about it. I've been studying. I've been on Bigger Pockets. I've done, interviews. I've talked to other really experienced real estate investors. I've posted in the forums, and this is what I've learned. I know all the stuff about it. I know the theory, and I also, even though I'm going to be going to school, I'm going to have all this other free time outside of it where I can hustle and put deals together, manage things, take care of things. Whereas they themselves probably don't have that time or inclination, then maybe they don't want to do that, right? So it's almost like you're offering them something that they wouldn't otherwise have without you, and you're getting something in return that you wouldn't otherwise have without them. So I just put a little slide here. This is just like the lender pitch, right? So this is kind of how you would be approaching those people. You'd be leading with your passion because you don't have experience. You'd be talking to them about the benefits to them, and the benefits to them would be primarily the interest rate that they're going to earn on their money. So I'm just going to jump back to the slide that I skipped real quick. So this is a little comparison of interest rates. And let me know if you can see this on the screen. And what you're seeing on the screen here is I just put together three different types of financing that you can possibly be looking at, right? You've got bank financing, which right now somewhere in the average of 7.5%. It's been fluctuating 7%, 7.5%, 8%. We're really in a pretty high interest rate environment right now.
Yeah.
Then you've got hard money lenders, which I'm sure you've read about, have heard about at this point. But
Mm-hmm.
hard money lenders are, for those people who might not know who are watching this later on replay, it's people who are in business of being a lender, but they're not the bank lender. Essentially they're like a private lender or a private hedge fund. They're privately owned, but they're in strictly in business. That's how they make their money. That's what they do, right? So with those people, you're looking at interest rates somewhere between 10 to 16%, and there are going to be additional requirements and fees, and they call them points, which are percentages of the loan amount that they're lending you, that you would have to pay them up front, or that they would essentially take a credit back for when they're lending you this money. So you're essentially owing them an additional amount when the time comes to fully repay them. And the other thing was with hard money lenders, typically, and there are different variations nowadays with hard money lenders, which some of them do act a little bit more like banks where they amortize their loans. A lot of these hard money lenders are doing interest only, meaning that for a period of several years or a year or several months, they're the only payments you're making to them are the interest that is
Mm-hmm.
accruing every single month. And then at the end, when the time comes to, if it's a flip, you would be selling it. If it's a rental property, you'd be presumably refinancing into a longer term bank financing. At that point, they get paid back the principal. Now, there are hard money lenders these days that act a lot more like banks, and they're pretty much indistinguishable from banks, except they may have some looser criteria for qualification, but they also are more expensive than banks. So there's a pretty wide range of those. But these are the people that are in business to make money through interest rates, through interest payments, through fees that they charge you, things like that, right?
Mm-hmm.
Then you have the private lenders, which is the last category, which is the category you're asking me about. And this is a complete, all based on purely agreement. There are no rules. There are no specific criteria or limits that you can be in. You can negotiate something with somebody for 6% interest right now or 5% interest. Most people probably won't go that low because they can get 5% from a CD in the bank.
Mm-hmm.
So I put 6 to 12% on here because I think that most rational people who are looking at things like, okay, I don't have to take any risk and I can just put money in a
Yeah.
CD and earn 5%, or a high yield savings account earn 5%. So I'm not going to lend it to this kid at 5% where there's a lot of risk and I could lose my money. Whereas in the other account, it's FDIC insured.
Mm-hmm.
And then everything in between, I've seen private lenders, even some of the private lenders that we've worked with, they say, okay, I want to get 12% or 10% is the typical number of interest rate for us. The loans that I've been able to get from private lenders for my real estate portfolio have been around 10% historically over the last 4, 5, 6 years that I've been doing that. So those are the people though that you can have really flexible terms with. You might have a period of interest only and then start paying principal, amortizing it. You might have it be all interest, right? Until it's time to refinance. You might have it be like the term itself, they might lend it to you at interest only for 5 years at 6%, right? Which is an awesome deal if you can get it, if you can find it.
Hmm.
But so what I come back to again, then, with regard to who are these people going to be for you, they are going to be most likely people that really already know you, they like you, and they trust you. And the whole key here is to make sure that you show them what value you would be bringing to them if you're going to go this route. The interest rates are number one. Number two is that you're going to hustle your butt off. You're going to make sure that the deal is successful. You're going to protect their money as much as you would protect your own money in this deal, and that there's a possibility for a long-term repeat relationship. So like a lot of the lenders that I have done business with, they've been with me and my business partner for years now. So some of them started with us in 2018, right? And we're in 2024 already, and they're still rolling their money over and continuously earning that interest from the money they lent to us as we refinance and put their money into use to the next deal and the next deal and the next deal. And so just a little background for you on myself. So I have 160 rental units right now. I have several other buildings under contract. So I'm still kind of in the process of buying. So I'm still expanding. But almost all of them I've purchased with private financing. And usually we're able to refinance the private financing after we turn the property around. We rehab it, put new tenants in, increase the rents, and then we go to a bank, we refinance it, which is this is the essence of the BRRRR strategy. And then we have that pile of money back, and we're obviously talking to our private lender throughout the process, and we're either saying to them, hey, do you want this money? Do you either want to just take it back, or here we have another deal that we're under contract for. Do you want to finance that? And every single time, almost since we started this, people wanted to just keep rolling it because it's really easy, very easy money for them. They're making 10% every single month, and they're very happy. So we have people that have lent to 300,000 to us, 350,000, 500,000, 800,000, 700,000, 100,000. There's a varying degrees and ranges depending on what the deal is and what their security is going to be in the deal. There's a variety of those options. But the key thing here, though, and this is to come back to your question and your specific situation, I didn't do that when I started. Like, this wasn't my first go-to when I started. Now, when I started, I already had a job, and I started with bank financing, and I built up that credibility and that track record and experience with several deals of my own through bank financing before I went to any private lenders. And that made it a lot easier to get people to say yes and
Hmm.
to agree to finance me. Because I think if I went to those people, and most of them are business associates, people that I've either worked with or people that I worked with knew and referred me to. That's how I was able to show them that this is secure, this is serious, and this is something that they're going to make a good return on, and it's going to be fairly safe for them. Because the biggest thing for them is going to be risk risk with you as an operator, as the investor. If you haven't done any of this before, if you're super young, it's a very difficult hill to climb to convince them to do it. Does that make sense?
I understand. That really helps explain what the private investors are doing and how you started. I just got my first credit card actually, so hopefully going to start building that
Good.
credit score now for the bank financing if I can somehow get that. Do you know anything about the bank financing, about like where I am now versus like sophomore year of college? If there's any shot that I can get a loan from a bank if I have built credit score for 2 years or so and looking into real estate?
Right. So I think the thing for you that what I would recommend you trying to do, and I don't know what your situation is with your parents or your family, if
Hmm.
there's somebody who's willing to be a cosigner on the first loan for you, that's probably the best way to go. So credit score is a good start. So if you develop a credit score, and if your credit score is, let's say, if you don't have any high debts, if you're very financially responsible, it's not going to be too difficult for you to build a credit score within a couple of years that is hopefully in the 700s, which if it is, you're golden on the credit score requirement, right? But besides the credit score, there's also obviously the income requirement. So almost every lender, every bank lender you deal with is going to want to make sure that you have an income, something outside of real estate, unless you go to the DSCR loans, which we can talk about as well. But they want to see that you have a W-2 income of some sort, or if it's a 1099 income, let's say while you're in college, you go and get your real estate license in Texas, and now you're a licensed agent and you can just start doing some stuff on the side. Maybe you can make some money through commissions and you can show that as your income. That's very helpful too. And along those lines too, I'll give you an example. So I own a real estate brokerage here locally. I'm in the Albany, New York area. And one of our agents started out while he was in college. So he started with another brokerage while going to school full time. He was, I think, sophomore in college, maybe. That's when he started, got his real estate license and started selling part time while he was full time in school. And so the first year and second year he did that, I think sophomore year and junior year, I think he made like 35,000 the first year, 45,000 the second year, which is not insignificant. I think it's something, right? It's
Mhm.
not obviously enough by itself probably to finance a purchase in today's market because houses these days are pretty expensive, but it's a really good start to show that you have an income coming in, and that's an easy way to possibly do it where you don't have the pressure of having to go 9 to 5 or whatever 8 to 4,
Mhm.
or afternoons or nights. You're not working in retail or something. You're actually doing something that's connected to what you want to do. You're in the real estate industry. With that, it's a matter of finding the right broker because you have to work under a broker. You can't be doing it on your own as a real estate agent. But that could be a really good path for you as an option to start earning some income while you're in school. So I'll say that. So that's the first thing I would say. And then the other thing is where I come back to a cosigner is that person will hopefully have a job and income,
Mhm.
and a bank will see them as a safe borrower, safer borrower than you. Because if for some reason you started defaulting on the loan, the bank is going to be pretty much out of luck because
Mhm.
they don't have anything, they can't take anything from you. They can't impose any liens or judgments against you aside from the mortgage that they're going to have on the actual property. But they want more than that. They're not happy because,
Yeah.
again, lenders want that additional security from the individual. So long story short, what I would suggest for you, as opposed to going with the private lenders route, I would probably steer you more toward doing a house hack as opposed to doing a private lender, super high risk, high interest, short term type of a loan. I
Mhm.
think it's a lot of pressure on someone like yourself if you haven't done it before. So my suggestion would be for you, and this is something that I saw in the forums, a couple of people that were responding to some of your posts. They were saying that, hey, maybe you can find a single family house that has several different rooms in the college town that you're going to be living in, right? When you're going to school. And I don't know, obviously it depends on what your school allows. I know some schools freshman year, they don't let you live off campus. There's
Mhm.
all these things you got to, work around. But just as a suggestion or a food for thought, maybe it's sophomore year, junior year, whatever, you find a multi or single family house or a multifamily house in town that you buy with your dad or your mom on the loan with you. You move into one of the rooms or one of the apartments and you rent out the others to your school buddies or other people, where you start learning how to be a landlord. You're going to be an owner of that property. And at the same time, it allows you to start getting the benefit of all those things that come with owning real estate, which is exactly what you want to do. To me, that seems like the best option for you, the most likely path to success. And so let me just show you real quick. This is, again, another thing that I put together for house hacking. So there's a ton of benefits, as I'm sure you know if you've done some research. So you don't need prior experience with house hacking loans. They're not going to ask you most of the time. They're not going to say, "Oh, did you already have one or two or three properties?" In fact, house hacking loans, the owner occupied financing, specifically designed, a lot of it is specifically designed for first time home buyers. So it's perfectly fine for you to be a first time home buyer and be a borrower from a bank. So that's good, right? Lower interest rates as compared to those other financing vehicles that I was talking about. Hard money lenders will charge you a lot, whereas house hack financing is going to be a lot less expensive. Same thing for private lenders, most likely. And then you also get to learn how to be a landlord and a real estate investor while living for free at the property. And that's exactly what I did. So my very first investment was a house hack. It was a two-family house that I purchased shortly after law school. So I'm a lawyer by trade. I graduated in 2010, and then in 2011, I bought my very first rental property. And it was a two-family house, side-by-side duplex, where I lived in one side with my wife, at the time my girlfriend, and I rented out the other side to tenants. And that really opened the doors for me, opened my, you know, the amount of experience I had, the knowledge, the information, like all of it was a learning experience. But it was a lot easier to do while I was living at that property as opposed to being across town from this house, or you know, being 15, 20 minutes away from the house is not the same as living there, because you can see
Mm-hmm.
exactly what's going on. If there's an issue, if there's a water leak in the basement, you know about it right away because you're there, right? So you can call the right person to fix the issue before it becomes a bigger issue. Also, the tenants that are living next door to you are going to be much more polite and much more respectful of the property itself because they know the landlord's living next door. So there's a lot of benefit that comes along with being an owner occupier landlord. So that's another thing. The third thing is, which is the really big thing, is the low down payment. And I'll talk about on the next slide about the
Mm-hmm.
couple of different options. And I'm sure, again, you've seen them, but a couple of different options that come along with that are available for financing. But low down payment is another benefit. And then long-term amortization. So a lot of the loans, in fact, most likely if you're buying with owner-occupied bank financing, you're going to be looking probably at a 30-year loan, which is what I would recommend, because that puts the least amount of pressure on you to make monthly payments. So the loan is going to be the smallest. And you can, if you want to pay extra, you can over time, but you're not required to. So, and that allows you to go ahead and stretch those payments out, and allows the tenants or most of the rent to cover most of the mortgage, and then you just make up the difference. There are, however, as we've just talked about, the need for, requirements for credit, right? You need to have a minimum credit score, which again I'll talk about on the next slide. You have income requirements. You have to make enough income, and then the debt to income ratio restrictions, which again, if you have recurring debts of any kind, you need to make sure that the ratios that the bank sets for the loan that you're looking at are met with regard to your income and your expenses monthly. So there is obviously the downside with that. But let's look at this real quick. So house hack loan types, right? They're really, I put them in three different buckets, because the first one is FHA, right? The second one is conventional. And then the third one is the specialty type. And I
Mm-hmm.
kind of lump a bunch of the different ones into that type because, in your situation, I don't think those other ones are really that important. So FHA, 3.5% down payment is the minimum allowed. Minimum credit score to be able to put that little down is 580, which is not very hard to meet, especially if you're starting to build your credit and you're going to be responsible about it. You
Mm-hmm.
should be able to meet it fairly easily, right? FHA actually allows banks to lend to people at a lower credit score, but then the down payment increases. If you're below
Makes sense.
580, if you're like 560, 520, 540, they might require 10%. It also allows you to ask for a seller concession up to 6% from the seller. So when you're looking at a property and let's say, you have enough money for the down payment, but you also have a bunch of closing costs, which you will with a bank financed loan, you can ask the seller to contribute to those. So let's say you were looking at a $200,000 purchase price on a property, right? And your closing costs are going to be like 10 grand in addition to the 3.5%. So you need to save 3.5%, 7,000 plus some additional closing costs. And then you can also ask the seller to basically credit you to give money back to you to cover those expenses up to 6%. So 6% on a $200,000 purchase is $12,000, which is significant. So it means that it reduces the amount that you have to necessarily come to the closing with, and so makes it much more affordable, much easier for you to finance something. So that's something to keep in mind with an FHA loan. And then there are also the easier debt to income requirements, and things that compared to other type loan types are probably going to be easier for you to meet than those other types. There is a self-sufficiency test, which applies to 3 to 4 unit properties. It doesn't apply to single family houses and it doesn't apply to duplexes, but 3 to 4 unit houses, basically what they do is they ask you, or they ask an appraiser to calculate what the market rents for this property would be for all 3 units or all 4 units, whatever they are, on a monthly basis. And then they take a percentage of it. I believe it's 75%. And then they ask, or they compare it to what your monthly mortgage is going to be. And if that 75% of those market rents for that property is less than the monthly mortgage amount, they will probably disqualify, or they won't allow you to get that loan. So that's a self-sufficiency test. And you can look it up more, and I'm sure you can get more detailed information from a lender and on Bigger Pockets or
Yeah, it
on
sounds like a good
online.
thing.
But that is a general, yeah, and it can actually keep you safe. But I mean, from my perspective, if you're smart enough and you know how to run your numbers and you know what you're doing,
Hmm.
I see it more of as a restriction than it is a hindrance or a helpful thing. But again, they're just trying to protect themselves. They're trying to protect the Federal Housing Administration and the bank when it comes to these types of loans. And then the other thing with that, I didn't have room to put it on here, of course, is if you're putting down less than 20% on an FHA loan, you're going to have a mortgage insurance premium on it, which there with an FHA loan, it's for the life of the loan. It's a certain percentage of the loan, and also there is a certain amount upfront. They call it upfront mortgage insurance. That will also be one of the closing costs as part of that loan type, compared to conventional loan, which doesn't have that same requirement. So you do have private mortgage insurance requirement, but with that private mortgage insurance, you can get rid of it once you've reached 80% loan to value on that property. So whether the property appreciates over time or you pay the loan down over time, you get to 80%, you can eliminate that monthly cost that FHA will basically keep for life as long as that loan is still active. So there's a little benefit with the conventional loan over the FHA loan with that. Hey guys, if you're getting value from this video so far, please do me a favor and hit the like button. And if you're just starting out with house hacking, grab my free house hacking checklist where I go over the 7 most important things you need to do before you buy your first house hack. This checklist covers not only what to do, but also offers some actionable steps you can take right now to get started. The advice in this ebook comes from my own experience with house hacking and from years of building my rental portfolio from a single duplex to over 160 units today. If you're interested in getting a free copy, check out the link in the description below. On the flip side, too, the conventional loan comes with a 5% minimum down payment requirement. And it used to be that just a couple of months ago, we were even higher. Conventional loans had higher requirements for 2 units, 3 units, and 4 units than 5%. This is something they just did. They just changed this. Fannie Mae just issued new guidance, and now banks are allowed to issue these types of loans for 3 units, 4 units, and duplexes at 5% down only, which is great. And this is something that house hackers should absolutely take advantage of right now. But it's 5%, it's not 3.5%. So there's a bit of a difference with that. Also, with regard to credit scores, it's going to be very lender dependent. So each lender will have their own overlays on top of the Fannie Mae requirements. But if you're looking at somewhere around 620 points and above, you're probably going to be able to do the 5%. And you're probably going to be able to get a decent interest rate. Obviously, the higher you go, if you're in the 760 and higher credit score, you're going to get the best rate. And obviously, that's something to strive for, and you want to try to achieve if you can in the next couple of years before your first purchase. But then with a conventional loan, you also have the downside, a little bit of a 3% seller concession, where with FHA, lenders will allow you to do up to 6%, ask the seller to give you back a credit of 6%. Conventional caps off at 3%. And so that, again, means that you're going to have to come up with some more money up front to come to the closing with and to be able to purchase that property. Now, the debt to income requirements are typically, again, could be very lender dependent, but typically are slightly harder to meet than the FHA, but not insanely so. I think that the differences are incremental. They're not as drastic as you might think. And then there's also no self-sufficiency test. So again, that restriction does not exist with 3 or 4 units right now. According to the Fannie Mae guidance, they don't require that. So even if the property won't necessarily cover the entire mortgage at 75% of current rents, you might still be able to qualify for that property and purchase it. And then finally, the specialty loans, they're the VA loans. If you were to go into the military and you put a couple of years of service in the military, you can get very favorable loan terms with that. Doesn't sound like that's the plan for you, so I didn't really go into much detail on it here. And then you also have USDA loans, which are loans that are available to borrowers who are looking to buy in rural areas, and there are specific areas in the country that are designated as rural. and they're only applicable to single family houses. This is something that you probably should talk to a lender about and look into, because if you're going to go with the route of buying a single family house, renting to your buddies who are in school with you, depending on where in town or in the suburbs close to town you are, you might be surprised that you'll find that it might be in that rural district, just because of how they do their maps and whatever their actuarial maps and whatever back end analysis that USDA does. They create these zones and maps. So might want to check it, because maybe you can get it. And with that, again, the requirements are going to be lower. The down payment requirements are going to be much lower, all those things. So it could be a beneficial thing for you to do if that's the route you go. And then there are also a lot of state specific loan programs. Not familiar with Texas, obviously, so, or other states. So I'm specifically in New York. We have some first time buyer programs that have some additional benefits that, again, a lender will be able to tell you if you're talking to a local lender or a lender who's licensed in your state, and they'll be able to give you those details.
Yeah, that sounds great. So I was gonna ask, I wrote down a couple things. I was gonna ask, what's your opinion on partnering, and how do you suggest I go about finding a partner? Like, is it the same like family type person, or should I try and find someone else? And then the other thing I was gonna say is I really, really agree with what you said about house hacking. I had like little plan written out, and I was in Texas, or especially the schools I'm going to, they're saying you have to stay in your dorms for the first year or so. So I was planning on finding a duplex, triplex, quadplex. I don't know if you have any opinion on which one would be better to do for my second year, since that's never I'll be out of my dorms. And then the last thing I was going to say is that at Baylor, which is one of my options, my aunt works for this broker that's like supposedly ranked really high in her agency. It's called Coldwell Bankers, or something like that,
Mm-hmm.
and she's
Yes. Mm-hmm.
really high. So I've been to her house, and hopefully I have good connections with her. So I feel like I could definitely get a license and start working with her. And I think that's probably going to be my plan if I go to Baylor. And I think that would be really beneficial that way.
Yeah, awesome questions. So I'll take them one at a time. So when
Mm-hmm.
it comes to partnerships, I'm a big proponent for sure. The big thing with partnerships, you gotta be very careful with who you select, how you find the partner, and getting into business with somebody. It's a very delicate and difficult thing. Again, it's very similar to finding good private lenders, but it also comes back to knowing, liking, and trusting. Once again, I come back to this concept over and over with a lot of different things in real estate, different aspects of real estate, because it's so important. So I've been buying real estate with a business partner since 2017. From 2011 to 2017, I was buying everything on my own. And I can tell you that it was so much more difficult to do that on my own versus to doing it with a business partner. And there are many reasons for that. There's some restrictions, some benefits of doing it on your own that you can't, which prevent you from using a partner. So for example, if you were going to do house hacking, and there are certain rules, again, co-signers or partners who are not going to be living in the property, that is something you should look into and talk to a lender about. There are going to be some rules and restrictions. I don't know if there's a difference between if it's a family member or if it's an unrelated person to you. You got to look into that and ask them. But when it comes to further on, later on, when you get into, let's say you start with a house hack, you maybe don't do a partner on that one. You just have a relative with you who technically is a partner because they have a vested interest,
Mm-hmm.
because they're a co-signer. But after that, when you get into maybe non-owner occupied investments and you want to build a little portfolio and you want to try to go that route, you're definitely going to want to, or you should anyway, look for a business partner. The way I found my current business partner is I've been friends with him since probably, so now it's been probably 21 years. So we've been friends for 21 years. We've been investing together for 6. So I knew him for 15 years before I ever did a deal with him. And he started investing in real estate a year or two before I did, separate and apart from me. And then I started investing in real estate, again, separate and apart from him. And we were just talking back and forth, exchanging some ideas, discussing real estate, discussing different deals, different things that we were doing. And then eventually had the conversation of, yeah, you know what, maybe we should do some stuff together. And it made sense, and it ended up working out. I did another partnership with another person who I was less acquainted with. It's someone who I knew. We played basketball together, just pick up basketball and talking about stuff, and came to find out that he was in real estate or doing some real estate deals. And we said, okay, like we talked about it, said, okay, let's try buying some stuff together. And we did, and it went fine. It just wasn't the best
Mm-hmm.
partnership for me, because, and for him too, probably because the things that you want in a partner for yourself are opposites of what you bring to the table. So both of you need to have certain skills and abilities and attributes that the other doesn't have that can complement you and them in your real estate venture. So, for me, like I'm really good with finances, getting private lenders, doing obviously the legal stuff because I'm an attorney, document side, all those different things like that, right? Whereas my current business partner is really good with people, managing people. He's really good with construction. He knows, how to get the best out of everyone on the team and get what we need done. And he knows how to push the right buttons. He knows how to when he needs to be talking to people a certain way, he does it, or when he needs to be stricter, he does it. Like those types of things, right? And so that's really valuable and important. Now I could do those things too, but I'm certainly not as good as him.
Mhm.
And so I let him handle the things that I'm not that good at, and he lets me handle the things that he's not that good at. And it works really well. And obviously, so aside from that, right? So that dynamic needs to exist. The other thing is obviously trust. That's the biggest thing because you're going to be dealing with a lot of money. You're going to be dealing with a lot of financial information and details where if you don't trust somebody that you're in business with, that you're partners with, it's a really, really scary place to be because there are so many stories where partners cheat their own other partners. They defraud them. They move money. They don't tell them that money came in or whatever the case might be. And you just don't want to be in that position. So you got to be really selective with who you're selecting as a business partner because of those things. So that's what I would say on the partnership end of things. Do you have any questions or follow-ups on that?
No, that sounds great. I was just gonna have a small follow up. You said that you're good with the finances and you were a attorney, right? I was wondering. I'm going to college. I think I'm probably going to go into finance. Do you think that that's a good degree to go into to help me out in this field?
So I'm not honestly, I'm not entirely sure if it really translates that well because when you're talking about degrees at a college and you're talking about finance degrees, they're going to be teaching you things that are more geared toward like if you're going to end up becoming a financial advisor, financial planner, or you're going to go into, some corporate environment where it doesn't really translate the same way into real estate. Now, there are certainly things that you need to know and basics you need to understand about how money works, how interest compounds, like all those different things, but they're so basic that I'm sure you already have that understanding having read 3 real estate books and been on the Bigger Pockets forums. You don't really need an official finance degree. The thing that I would say is if you did want to have some correlation between the degree that you have and real estate, I think doing something like marketing, learning how to market and sell, that might be much more beneficial to you if you want to make a career in real estate, if you want to grow wealth in real estate at a much quicker pace, that might be something you might want to consider. But in terms of like finance, and a lot of people, wasn't sure if you were going to ask me this, but like people ask me, oh, should I go to law school after I'm done with college? And I'm sure people are going to say, oh, you're biased. And some of my attorney colleagues are probably going to say, this guy, he left law firm world and now he's telling younger people not to go to law school. I'm not necessarily saying that. What I would say is that I went to law school, as most people I think do, because they think that being a lawyer is number one, really prestigious and financially lucrative, right? And to a certain extent, it is when you compare it to the average population. But the other side of things in that field is the amount of work that you have to do as a lawyer and the amount of time you have to put in, and the fact that you get paid entirely based on time or almost entirely based on time. Like lawyers bill on an hourly basis. That's the thing that they do. So while they're professionals, while they are very highly trained people with a very high set of skills and knowledge, specialized skills and knowledge, they are essentially hourly workers. There's just no way to get around it. I'm sorry. I know lawyers tell me, complain and argue with me about this. And there are certain fields or areas of law where you can charge a flat fee and charge based on results as opposed to your hourly input, but it's a lot less than you would think. And so that means that when someone becomes a lawyer, they're sitting at a desk for however many hours a week, every single week. And even if you're a partner in a law firm, which you don't get to be right away, you're spending 10 years or plus before you could even be considered a partner in most of these private firms. you're still putting in those hours. Now, you might have people working underneath you. You might be getting a cut from whatever they bring in, so to speak. But again, everything goes back to the client and it's typically billed on an hourly basis. So the client sees a bill and it has number of hours on the left side and the dollar figure on the right side. And then at the bottom is the total ledger that adds up to the dollar figure that they owe the law firm that month. And then they pay it. So, and then everybody at the law firm gets paid out of that. And again, it comes back to you're working on an hourly basis versus working on a results basis. And
Hmm.
if you want to not have a ceiling on your ability to make money, you can't work on an hourly basis. You have to work on a results basis if you're going to work for someone or have a service type of business, or you just need to be an investor where it's completely unlimited, where I could do a deal, find a really good deal with my business partner for $350,000 to 10 unit, let's say, which is exactly something we did in 2018. Renovate it, raise the rents, and then 2 years later go and refinance that property, pull out a ton of equity from it, still keep it, still have it completely cash flowing, and then and have it appraised for $1.15 million. The amount of time that I put in to do that to earn several $100,000 on the deal is minimal compared to the amount of time it would take me as a lawyer sitting at a desk billing hours for clients for 2 3 years to earn the same amount of money. You know what I mean? So that's the difference, and that's what you want to consider and think about as you're looking for a degree. Now, I'm not knocking degrees. I think you should absolutely get a degree. First of all, I think going to college is a good experience. Number one, that's something you should have probably for socialization, for just life lessons and value. I'm with that. Okay. Second thing is I think you need to make sure that the degree you get will allow you to get a job after you're done, and a job that will cover the costs of your degree. So a lot of times people and young people, I was the same way when I was going to college. I wasn't looking at what it was going to cost me on the back end when I'm done with school to pay back my student loans and how much were my payments are going to be. I didn't even know what the total amount was going to be, to be honest with you. Seeing as how you are very focused and driven and you're doing your research, I think you should consider that and see what it's going to cost you at the end of the day. After 4 years, project how many loans you're going to have, what dollar figure on those loans it's going to be, and what the interest rate is going to be. And then look at it. Okay, if I had to pay them off in 10 years, what are my monthly payments? If I had to pay them off in 20 years, what are my monthly payments? 25 years, what are my monthly payments? And then factor that into whatever job prospects you have with the degree that you choose. That's what people should be telling young people like yourself to do. And I feel like almost nobody's doing that because it's almost like, oh, well, everyone can get a loan. You can get a loan, you go to school, and then you hope and pray that at the end of 4 years, you can get a job that covers those loans. And a lot of people have a rude awakening when they come out of school and they don't realize that that didn't happen. And now I'm stuck and I'm working as a barista at a Starbucks, not even making nearly enough to cover the minimum payments on my loans. And now they're all complaining, asking for the government to forgive them. You know what I'm saying? So that's, to me, that's a huge disservice that people in the know, the financial advisors, the guidance counselors, and the colleges themselves, they don't really educate kids on that before they start borrowing these huge sums of money and how that'll impact their future after the fact. So anyway, to answer your question, I consider marketing something to do with that. Possibly maybe something to do with business, just business
Hmm.
administration or whatever the case might be. I would look into that. I think among your questions was also the question about Coldwell Banker and a relative of yours that is with them. Is that right?
Yes, sir.
Yeah. So I think that's great. So Coldwell Banker is a very large real estate brokerage. They're national. They might even be international, but it's a brokerage model where you can buy into it. So like local people, like I could sell my business right now, right? My private real estate brokerage, and then go and buy a franchise from Coldwell Banker and use their name, use their products, or use their systems, and then start hiring agents to work under me as a broker. And now I would be part of the Coldwell Banker umbrella, right? So because you have that connection, I think that's a great thing to do. And then you can get the experience from your relative. You can bounce ideas off of them. Like all those things are great. The only thing you're going to have, because it's a large national or international brokerage, is there going to be some pretty strict guidelines and things that you have to do probably. So it might vary from franchise to franchise, and maybe the local broker does not have those restrictions or requirements or certain variation on them. But a lot of them don't allow certain out of the box things when it comes to real estate investing specifically. So you may be kind of pigeonholed a little bit into buying and selling with just percent commissions as opposed to flat fees, or you might not be allowed to do any wholesaling, let's say, if that was an option with someone else. So just keep that in mind. And I would say still, even if those are the restrictions, start there because it's the easiest way to get in. Learn how to do the basic stuff, learn how to do the on-market real estate sales and maybe even leasing. Maybe you do some work where you're leasing properties for landlord clients. And then that could be a way for you to get in and even buy something from those landlord clients if they decide to sell or even partner with somebody. So I would consider that as an option for you as well. But I think that's a great thing. I think that doing that part time, maybe 10 hours a week while you're in school on, let's say, weekends and maybe nights, I think that could be a great thing to do.
Yeah, that's really what I was thinking. And that's the first time I've ever heard the stuff about college. Like you said, no one really talks about that, and I think that's a really big deal. I mean, one of my family members is going to. I mean, she's been in college for 8 or 10 years, and she's going into like a history degree, and she's not going to have nearly enough to pay everything back.
Right.
And so, I
Right.
mean, originally when I was just getting into high school, I was looking into being a doctor, and my mom's a doctor right now, and she was like, "You get paid
Mm.
well, but the way it's going, it's not. It's almost not going to be worth going to school that much to become a doctor." So that was really good. I've heard a little bit of marketing, and I think that sounds a lot better than finance to me. I've been told to go into finance, and I'm completely okay with that. I'm good with numbers, but marketing sounds a lot more real estate focused. I think because it's a lot of marketing to find those off market deals.
Anytime you get to learn how to sell and how the selling process, the process of attracting someone to a product or a service, that's what you want to learn because real estate is so much buying and selling. And that's it actually goes across to other industries as well. So even if you weren't necessarily going to make a career in real estate or build a huge portfolio, maybe you just buy a few properties, but then you end up veering off into something else that is business oriented, that is your own business, something that you are building from ground up. Learning how to sell and market is one of the biggest number one skills I think for the near future for everyone that are going to be very important for everyone.
Yeah, I'm really that sounds like the best plan from right now. I was gonna ask you, so you were talking about the FHA loans and that they had PMI for the life of the loan. If I was to go that route, would you suggest getting that loan and then refinancing out after I've forced equity and then going into a more conventional loan? Is that possible? Like, is that the way to get out of that PMI situation?
You can definitely do that. Absolutely. That would get you out of the PMI situation. The other thing that would do is it would free up the ability to buy another property using an FHA
Hmm.
loan. So you can only have one FHA loan at a time, except in some very limited exceptional circumstances. So it makes sense to refinance it if that's the goal. So if that's the goal, and if the other goal is to get rid of the PMI, that's a good reason to do it. The only thing that I would suggest to you is obviously when the time comes, if you're considering that, you got to look at the costs of doing it. So let's say 2 years from now, when you're looking to buy your first rental property, right, as a house hack, let's say the rates drop to 5% or 5.2% at that time. You get into an FHA loan, you own the property for a couple of years or a year or whatever, and then you decide you want to refinance it to save the $230 per month that you have to pay in PMI and because you want to buy another property with an FHA loan. Well, you got to look at the cost as well of the refinance because you're going to have additional attorney's fees. You're going to have a new appraisal. You're going to have closing costs. You're going to have lender fees. Like all those things will add up. So they're just going to be additional costs to you doing that loan, which could be $6,000, $7,000 or more at that time. And so you got to look at, okay, I'm saving myself $230 a month. How many years of $230 per month payments do these additional costs of refinancing add up to? Because you might be looking at it as, man, it could be like, it's like another 7 years before I can start seeing a benefit from doing this refinance. If you're just looking at it from the standpoint of eliminating
PMI
your
only.
private
Hmm.
mortgage insurance. Yeah. So that's something to consider. Obviously, if the additional reason is to use FHA loan on another property, that still makes sense. And so just think about those things as you're evaluating all the factors. But I think absolutely, yes, refinancing will allow you to get another loan and will allow you to, cover those other bases and eliminate the PMI or a mortgage insurance.
Last thing I was going to say about FHA is I've heard that you have to have the property for a year before you can refinance. I'm not sure how much that holds up. I should probably ask a loan advisor or whatever. I was just going to ask if you had any experience with that and what you think about that.
Yeah, absolutely. So every single owner occupied loan in all those categories that we've talked about is going to have that requirement. So you do, and it's pretty strictly applied in the sense that every single promissory note and mortgage document is going to have that restriction in it. So it's going to say you have to occupy first of all, it's going to say you need to move into the property within a certain number of days after closing. And I don't know exactly where that stands right now, whether it's 30 days, 60 days. I think it's something like that along those lines, right? So that if the property you're buying is currently occupied by tenants, and let's say that they're planning to move out within a certain period of time after you close, it's on you to make sure that they do move out within that time frame. Otherwise, you could be in default of your loan obligations. So that's the first thing. So you have to move into the property within a certain number of days, and then you have to stay in that property as your primary residence for at least a year. So the full 12 months from the date of buying the property to the date 12 months later, you have to stay in that property before you can move out and either move into a new property, or even if you were to move back with your parents, let's say, right, after 12 months, and what you want to rent out the unit that you were occupying, it still has to be a 12-month period. And this applies both to FHA loans and conventional loans and any other owner occupied rental property loan that you end up getting.
Okay. Okay, so I didn't know that was for conventionals too. So that's awesome. If I am forced to live there for, let's just say, a year, can I still refinance into another loan but still stay there for a year? Or do I have to wait for that year to be up to refinance?
No, you don't have to. Right. So you can start refinancing anytime. You can also
Awesome.
sell the property at any time. There's no limitation on that. The only thing is, again, when you do the refinance and you're going, let's say, from an FHA loan to a conventional loan, you might want to ask the lender in that case how long you have to stay in that property. Because what you don't want to happen is for the 1 year time period to restart itself. Let's say you stayed in the property for 6 months after you bought it using an FHA loan, and then at month 6, you decided, okay, I'm going to refinance into a conventional loan. You just don't want that new loan to say that you have to stay in there another 12 months from that date. You know what I'm saying? If the plan is for you to try to move
Hmm.
sooner than that. So that's something you should talk to a lender about. I don't know exactly how that issue is resolved. But to me, I would say that it would make sense that it would only be the additional 6 months and not an additional 12 months. Because again, you've already been in that property. It's not a purchase loan, it's a refinance loan. So, but definitely talk to a loan officer about it.
No, I completely agree. That's great. Let's see. I had another. I was looking into. So originally, whenever I first started learning, obviously I'm learning new things each day. I was like, okay, I need to do single families, and then I learned about house hacking, small multifamily stuff like that. I was wondering, what's your opinion on duplexes, triplexes, quadplexes versus maybe like a small 6 unit, 8 unit, 10 unit. Where should someone that's beginning out start, and then scaling from there? Like, let's just say I'm house hacking for 6 months in a duplex, whatever it is, and I refinance. Do I go for, let's just say, another duplex, or do you think it's best to scale like maybe a 6 unit, then like a 12 unit? What would your what did you do since you actually house hacked, and where would you say to go with that?
Those are great questions. So again, I think we want to unpack them a couple at a time or one at a time. So the first thing I want to do is let me just pull up another slide presentation that I put together. And this one is just comparing single family to multifamily in general. And then I'll get into some of the specifics that you asked
Awesome.
about house hacking and then duplexes, triplexes, and quads. Single family versus multifamily, right? There are certain advantages and disadvantages with each one when you're comparing them. And some of them apply more with owner occupied. Some of them apply across the board, whether you're owner occupying or whether you're non-owner occupying those properties. So just as a general rule, when you're looking at single family houses as a rental property, you're going to be competing against other people who are not investors, who are looking to just buy the property and live in it, right? So there's technically and typically a lot more competition from regular people. So those people are going to be looking at the house very differently than you will be. So whereas for you as an investor, you're looking at a lot of the numbers and how much rent income it's going to bring and what the expenses are going to be compared to that rent income. A lot of these home buyers are not going to be looking at it that way. They're mostly concerned about school districts, amenities in the property, layout of the property, backyard, like all these other things that you wouldn't necessarily care about as an investor. And so that makes it sometimes a lot more difficult to negotiate and win a bid if it's a hot market like it has been for, in most markets across the country, to win that property, to get that deal. Because while your numbers, let's say, favor a maximum purchase price of $200,000 for this property, the home buyer who's looking to just move into this property and who's probably lost out on a bunch of other sales recently and likes the school district or likes this property for some reason, they may be willing to pay a lot more than what you're willing to pay. And so in that case, you end up losing out on that property before before you ever buy it and look at any of the other uh, features of it. You may not even get it because that's who you're competing against. So that's the first thing with single family houses. On the flip side, too, it may be cheaper and easier to finance a single family house. As we talked about, USDA loans, for example, in rural areas, you apply to single family houses. And I don't remember the exact down payment with it, but it might be something like zero or something really close to it. It's going to be a lot cheaper potentially for single family houses than for multifamily houses. So that's a benefit of buying a single family. It's also going to be a lot easier for you to sell that house. If you did get a single family rental property, you're going to again have the benefit on the other side of it of having a much wider pool of potential buyers who would be interested in that property. Whereas if you had a multifamily property, only those people who are investors or who want to be house hackers would be interested in buying that property, which is a much smaller percentage of the general population. So again, single family houses in that respect are a little bit better than multifamily houses. Also, now we come down to owner occupied versus non-owner occupied situations. So if it's a non-owner occupied single family house, right? Typically, you're going to have only one tenant or a group of tenant which are renting by room, but at the same time, you're essentially still looking at them as one occupancy as opposed to a multifamily where, let's say it's a 4-unit, you have 4 different sets of tenants. So if something happens with one tenant in your rental property, meaning they lose their job or they can't pay you for some reason or they stop paying you, the entire income stream from that property stops right then and there. Whereas if you have a fourplex and you have one of the 4 tenants who loses their job and they stop paying you, that's only a quarter of the entire income that property is generating. And it's pretty unlikely. It would have to be something seriously drastic that happens for all 4 of them to at the same time stop paying you for whatever reason. So it's much harder for you to lose all income on a multifamily property versus on a single family property. And that is a big thing, especially, just being in this industry and been doing this for 11 years to 13 years, however long it's been now. I've seen that happen and it's not pretty. You do have to dig into your pocket to cover a lot of those costs while you're working on an eviction to get that bad tenant out and hopefully get a new tenant in. So that's a big thing. Now, if you are owner occupying that single family property and you're renting by room, right? Or maybe there's a granny apartment or whatever. Mainly I'm talking about renting by room because a granny apartment in theory you would have a separate entrance. And so I would put that more in the duplex category rather than the single family category. But let's say you're renting by room and you have multiple people living in your property with you. So you're still getting the benefit of living in that property, owning that property. So the concern about people not paying you is not as bad because you have something that is providing other value to you other than rent. But the issue there is that you're sharing your space with a bunch of people. Now, in your situation, because you're going to college, it's normal. You're going to be sharing space and it's probably cool and it's fun and it's not a big deal. But as you get older, as you graduate, you get into a serious relationship, you probably don't want to be sharing kitchens and bathrooms and living rooms with people who are technically strangers or even friends. And that becomes more of a concern when it's an owner occupied house hack situation. So I've always looked at it as I want my own space. I want my own privacy. Now, with that said, I didn't start buying until I was 26. So it's a different age dynamic for me than it is for you right now, but something you should think about and consider. And then the other thing with single family houses where you're renting rooms is, let's say you're doing it as an Airbnb and they're not friends. They're just totally strangers. They're coming in for a weekend. They're a couple of days a week, all that stuff. That could be good as well, but it can get old pretty quickly too, because again, if you're still sharing the common areas with those people. And those people are even less familiar to you
Mhm.
because they're only there for a few days as opposed to months on end. So to me, all those things combined, like I personally don't like single family house hacks that much. And I also don't like single family rental properties that much. Now, some other things that are kind of the flip side of it. So with multifamily, again, as I mentioned, there's less competition. There's also economies of scale where I have a lot of 4 units. I have a lot of 6 units, 5 units, and so forth. When I have a roof issue, a roof needs to be replaced at my 6 unit, it's just one cost, one replacement, one contract with a contractor who does that work. Whereas if I had 6 single family houses that were equivalent to my 6 unit, and I had a roof leak with each of them, that's a lot more cost. That's a lot more administrative headaches. That's a lot more legwork and expense. So the economy of scale favors multifamily as opposed to single family. Now, with multifamily, it is harder to sell them because, like I said, only the investors and house hackers would be interested. And the positives there is just that they don't have the shared living concerns because, again, you have separate units if it's a house hack. And it's easier to cash flow those properties as opposed to single family properties, in my experience. And so to go over to the other question that you were asking, which is, do I go with a duplex, triplex, or quad as my first house hack? I think it really depends. And I'm not eliminating for you personally because of your situation with college and everything else. I'm not saying you should eliminate single family houses from your house hack equation. It may still be a good deal for you in town if that's what's available, and you can make good money with it, renting and by room and all that stuff. So don't totally, eliminate it just because of what I'm saying is my personal preference. But as you get older, it might be more of a concern. But if you're talking about duplexes, triplexes, or quads, the thing that I would suggest is, number one, you need to see what's available on the market and how hard it is to find something, because that could be an issue too. So like in my market, we have a lot of duplexes. Like duplexes, obviously single families, but the next thing up, duplexes are the most numerous. Then you have the triplexes, which are less numerous. And then you have the fourplexes, which are even less numerous than the triplexes. And then you have the larger five units plus, which there are fewer still, right? So it's always a hierarchy of these types of properties. So, but when you're looking at a house hack, you also want to consider location, whether there's a lot of crime, how safe is the neighborhood, and how comfortable are you going to be living in it? Because again, you have to live in it for at least a year. So the comfort level is going to go down as you go up in units, because typically you're going to have more neighbors around you, more noise, more shared common space outside of your apartment that could still be problematic or an issue or an annoyance, right? So, you have pets, dogs barking, all that stuff. You're just increasing your discomfort the higher you go in units. Now, on the flip side, you're making a lot more money with it. You might even be able to cash flow if you can buy it really well on the front end. So consider those factors. Don't discount anything just because of that. Me personally, I started with a duplex. Also, me personally, I looked for a very safe area with a really good school district, and I paid a premium for it. And I knew that I was doing that, and it was a conscious decision for me. And so my feeling was, because my girlfriend at the time wanted to live in a nice place. We loved the location where it was, a dead end street. We had a really nice green backyard with a creek in the back. So it was a newer property, so it needed a lot less repairs and maintenance up front. And we knew that we'd be able to attract really good tenants who were going to be respectful, going to take care of the property, all those things. But also on the flip side, I knew because I was paying a lot more for the property than I could have if I looked in different areas and looked at older properties, I wasn't going to be making cash flow that much, even after I moved out of the property. So I knew I wasn't going to make any cash flow while I was living at the property, but I also knew that my cash flow after I move out was probably not going to be very high. But I was going to be able to grow equity in this property, which it has grown in equity and in value pretty significantly over the last 13 years. So there are a lot of these push and pull trade-offs. I'm only listing them for you just so you can consider them as you're doing your research and as you're looking at what's available in your market. But for me, it was a duplex. It was easier for me to get started that way. It's only one tenant to manage. It wasn't 3 or 2 others. I was still learning. I didn't know much of anything about real estate, construction, any of that stuff, management. So it was easier to do it with a duplex. So most people that I talk to that are asking me this question, I would tell them probably a duplex would be a good idea. But if you don't mind going up and some of those discomforts, go for it. The other one little caveat I will mention, this is something that has come up in Bigger Pockets forums, and I actually spoke with David Green's business partner on the lending side, and I interviewed him on my YouTube channel. I can put a link in the description to this video, and I'll send you the link to check that out. He told me something about scaling. We talked about scaling using house hacking, trying to build a small real estate portfolio using house hacking. And there are some limitations with that strategy. And some of them are specifically relating to what type of house is your first house that you buy as compared to what your next one is going to be. If you buy a two family house, right? That's like, let's say, just for specifics, let's say it's a 2 family, 3,000 square foot house. It's side by side. You got a garage and a driveway on one side, garage and a driveway on the other side. You've got 3 bedrooms on each side, 1.5 baths. You got a patio in the back. You got a nice big backyard, super nice property, right? And let's say it's only 20 years old. And then you live there for a year and now you want to buy another one, right? And the next one you want to buy is a 4 unit. It's maybe farther away from your work or school or whatever, right? It doesn't have any garage. It doesn't have a driveway. It's street parking. And it's 4 2-bed, 1 bath units in that property. What an underwriter and a lender is going to be looking at, not all of them. You might be able to find a lender that doesn't care about this. And that's great. Some people have done that, and maybe you can still do it if you do enough research on it and find those people. But certain lenders will look at this and they will say, we don't believe you that you're going to be moving into this property. We don't believe that it's an upgrade for you. So lenders will consider whether going from your first house hack to your next house hack is an upgrade for you in lifestyle or property. So that what they want to see generally is they want to see you going from a less comfortable living arrangement to a more comfortable living arrangement with each successive house hack. And so what he told me on that podcast episode was that his lenders he works with have that restriction, and it's going to be very difficult for someone to go from my example of duplex to that example of fourplex that I just used. Now, if the situation is reversed, now it's a different story. So if you took a 4-unit property and you went from a 4-unit to a 3-unit, where you're increasing your living space, a little bit more comfortable, it has some additional amenities that the 4-unit didn't have, then that concern is alleviated. You don't need to worry about it. So that's something to consider. It's just there's not really, I don't think there's a specific name for this, but it's like you can talk to some lenders and they can explain this to you. But that is something that some of them do consider and look at. The other thing with scaling, of course, you have to consider too, is each time when you're looking to qualify for the next house, they're going to be looking at your debt to income ratio. And of course, the first house hack that you buy is going to add to your debt side. It's also going to add to your income side, but it's going to add to your debt side. And you got to be very careful as to whether or not you can meet the debt to income ratio, considering those additional debts and income from your first house hack to your second house hack. And some people have written on Bigger Pockets where it was a problem for them. They weren't able to do that. So that's something to really hone in on and be mindful of when you're considering how much it's going to cost you for your first house hack and what you're going to be looking at for the next one. Now, I realize that you can't really, chart it that way when it's so uncertain in the future, but it's just something that you could, as you get closer to the first purchase, you can start mapping some of this out and putting some numbers on paper to figure those things out. With that, so when you're considering buying another house hack and you already have rental income from the first one, the lender should be able to take 75% of the gross rent that your current house hack would generate once you move out of it and put that on your income side. So that should help you with income a little bit, but depending on how much the mortgage is on the first one and what the other expenses are, like taxes and insurance and things like that, it might not help you enough to offset that. Do you know what I'm saying?
Yeah, that makes sense. I haven't heard about that, so that's a really good insight to look at. I didn't consider at all looking at the debt to income ratio from house hacking, especially going from a duplex to a quadplex, how that's a decreased, style of living. And that's something that's really, really, really good to look into. I definitely will look for that stuff in a market. Is there anything else specifically that you look for in a market besides like a good location, like at the end of the street, crime rates, school districts, stuff like that? Is there anything else that like really, really stands out to you that can help you in a market?
No, I think those are the main categories. Some of the other things that my business partner and I look at for our non-owner occupied investments, the intersection between price and rents. There's different rules of thumb, but for us, in our market, if we're spending $50,000 to $75,000 per unit on a property, each of those units need to generate over $1,000 gross rent. And most of the time we want to try to get $1,200, $1,300, $1,400, something like that. Now that may or may not be possible in every market. We have certain pockets of our market where that is possible. And I'm not talking about the existing rents on the property. because we a lot of times we buy properties that are financially distressed or physically distressed. So it's just the end result, the after repair rent, ARR, that this property will generate. So that's what we look at. So we need to know, okay, we're investing this much. What's going to be our return on investment or on a gross level? And there's a ratio, I'm sure if somebody did the math on it, what that comes to. But that's our current criteria. It can change with the markets. It can change with, as time passes, things get more expensive. There's a lot of different variables to it, but price to rent is what we do look at for sure.
Mhm.
And the nicer the school district, the worse the price to rent ratio will be. But then in those areas, you're then bumping your investment up on the equity appreciation side. So there's a trade-off there as well, and also the ease of management. So those things are kind of in inverse relationship with each other, and just depends on what your strategy is, what you care about more. Like for us, we like forced appreciation and we like cash flow. That's what we target. So we are in blue collar markets. We're in like those B minus to C plus areas and properties. And that's our strategy that we're applying. Doesn't mean that it's wrong. There are other investors that are doing it differently than us, that are going after A minus A areas and properties. They're not making much in cash flow, but they're making a ton in appreciation. When they do go sell or refinance, they're able to get the value of that appreciation. And then there are other investors who look at strictly student rentals in downtown areas or larger city areas in my area. And that's a separate strategy, because with those, you have a lot of turnover. You have a lot of management there with students dealing with the properties, and you're renting by room typically. You're talking about beds as opposed to units for that strategy. We don't do that. It's not something that we want to do. That's not our niche. But again, every different investor you talk to is going to have their own approach to real estate investing. And those are just three of the many different categories that are in existence.
No, that completely makes sense. I was also looking for more cash flow and forced equity versus solely just like holding on and, like at these A plus neighborhoods. I know we've been on here for a while, so I just have like two or three more that I wanted to ask. I was going to ask you, you've kind of went over scaling, and I've heard that, you should focus on one thing, and then, once you've mastered your niche, then move on to the next thing. So of what you've said, how would you, like, if I'm house hacking my first house like you did you scale by refinancing after like 6 months, living in the house? And then would you suggest going to buy other things while I'm still in that first house hack? Or what would you suggest on that aspect of like scaling from there?
That's a really good question. So in my case, I had a pretty good paying job. And so once I started saving money on my living expenses by living in my house hack, that allowed me to accumulate even more money quicker. So it made it easier for me to do another non owner occupied deal 2 years after I bought my first house hack, borrowing 75% of loan to value. So I was able to accumulate 25% of the purchase price of my next purchase as a down payment in my bank account. So I just went in, put that on the next property, and that's what I did. That may or may not be like an option for most people. I think from my perspective, for you, I think you should try to buy at least one or two or three house hacks after your first one, because that will allow you to do that with a much lower expenditure up front because of the down payment requirements. So even if you did one FHA, you kept it. Let's say you didn't refinance it. Just say it doesn't make sense financially, numbers wise, interest rate, whatever the case might be, after the first year for you to do that. But you can then still use the 5% conventional in the next one. So you go and do that second year. And then the third year, you're able to do another 5% conventional. So now you got three rental properties that you bought over the first 3 years. That's an awesome start. It doesn't have to be your end point, but it could be an awesome start with pretty low upfront investment on your part. And you're going to already then have a ton of experience. You're going to know how to manage properties. You're going to know how to deal with tenants, deal with maintenance issues, repairs, all those things. You're going to have a ton of wealth of experience at that point, right? And then you could start looking into private lenders or partnerships and scale it from that standpoint. And you might like even say, okay, I'm not going to deal with banks anymore, or at least on the front end, I'm going to do private financing and just scale that way, and scale your way up to 10 properties or whatever the case might be. So that's what I would probably suggest to you and people in your situation. But, in terms of refinancing, like we talked about, you can do that if it makes sense, if there's a real reason to do that and the goal. I think difference between 3.5% and 5% down payment is not that great. Like you could probably swing if you had a year 2 years to save before your next purchase, you can swing an extra 1.5% for a down payment. You know what I'm saying? So as opposed to spending, because it's probably going to cost you 1.5% just to refinance that first
Hmm.
house hack, first FHA loan. So if you wanted to use an FHA loan again, does it make just to save money on the down payment? It might not make sense, but you got to look at all the numbers. So yeah, so to answer your question, I would think about trying to house hack, trying to do a serial house hack, multiple house hacks in a row to start, build that experience, build that foundation, and then move on to another, investment strategy.
That's a great idea. I'll definitely highly consider doing that. I'll probably that's probably the best option for me. The last thing I was going to say for financing houses and stuff, have you done anything for like for sale by owner? I have a family member who lives in Austin who's was really successful real estate wise, or second distant family, whatever. And he's in his, I think, older 70s and stuff. So I'm not
Mm-hmm.
going to obviously go to him and just ask for houses and stuff, but I'm meeting with him in the next couple weeks. And hopefully, if I can get a good relationship going on with him, there's a chance for getting a for sale by owner on his properties that he's, ready to send off and just get a note instead of having to manage these properties. Have you heard anything about for sale by owner? Have you done anything with that, or what do you suggest on that aspect?
I've done everything there is to do when it comes to rental properties in terms of financing them, finding them, all that. So yes, for sale by owner is a great option. Some benefits of it are just that you're not dealing with somebody represented by a real estate agent. So there are fewer costs to that person in selling the property to you. So that means that you can possibly get a lower price and better deal on that property. Now, if it's a true for sale by owner, what we're talking about is somebody actually put it up on Zillow or realtor.com or whatever, Craigslist, and put a price on it and they're advertising. So if it's a if it's a reasonably priced property, you're probably going to be competing with a bunch of people. However, if it's somebody like you said, like they haven't put it up for sale, but you know them and you have an in basically with them, whether they're a family member or someone else, that's the best situation you can have, because then you're not competing against other people. You can come to terms with them privately essentially on it without even the world or anybody knowing that this property is up for sale. So that's the best thing. And that's how we've purchased, like I'd say probably 85 to 90% of our properties have been purchased by reaching out and speaking to those individuals who are considering selling, or in some cases they weren't even thinking about selling their rental property, but because we approached them, we had the conversation, we showed them the benefit of selling it to us on the terms that we were offering, they decided they wanted to sell. So that has been extremely beneficial for us to approach those people and target them that way. Now, I think the other thing you might be asking about or referencing here would be seller financing. Seller financing is a whole other thing. So for sale by owners is just how they're selling it. Seller financing is how they're willing to allow you to
Hmm.
buy that property. How are you going to finance it? So with seller financing, we've done plenty of those. You can get terms and interest rates and benefits of a loan that you might not be able to get from a bank. You might not be able to get it from private lender or hard money lender. So some examples of the seller financing that we've done is we've gotten 0% loans from people. So as an example, there's a 4 unit that my business partner purchased in one of those areas that we were talking about, middle class C plus neighborhood, B minus neighborhoods, where the guy wanted to sell. My business partner just gave him a flat price and said, okay, $160,000 for your 4 unit. This was a few years ago before the prices went really crazy. But $160,000, we're going to give you 5,000 down, and we're going to pay you this monthly amount for the next 10 years, right? Didn't even say anything about an interest rate, but the dollar amount that he calculated that he offered this guy included a 0% interest rate. So basically it was $155,000 divided by 12, divided by 10 years, 12 months. So whatever that number came to, that's what he started paying him. The guy agreed, and they signed everything, did the closing, he took over, and he's been paying it. And I think he actually just recently they paid it off completely. So that property is completely 100% paid off now. And the entire purchase price, the loan, was paid off from the rents of the property. And so it was an awesome deal for him. And these types of deals are possible for you to find when you're dealing with people directly with no agents and the property not being on the market. So when I told you that private lenders, you could negotiate anything on terms, the loan terms are very flexible because it's completely by agreement between two private parties. It's the same thing, and possibly even better with seller financing. The biggest trick or issue with seller financing is those are very hard to find. And again, you have to really be well versed in real estate and real estate numbers, and be able to communicate with that potential seller very well to get the deal that you want. So, some sellers are more savvy than others. And so he might be way more savvy than you, and you might end up getting a worse deal out of it because he knows how to negotiate, and he knows what he wants and what terms are good and what aren't good in the market, whereas maybe you don't. And so it could be a benefit, and it could be also a detriment. It depends.
Yeah, that's a great point. I was watching one of the Bigger Pockets podcasts, and these two 19, 20-year-old guys were calling all these brokerages across. They lived in California, so their price to come in was crazy high, but they were calling all these brokerages in Texas and asking if they knew anyone that was seller financing, and that's how they started their, I guess, real estate portfolio. So I was considering doing that, especially since I know a high level broker in Waco, which is where Baylor is. It sounds like if I can get a deal like that, and it's a deal that works not from both of our perspectives, I guess that it's a good option. I feel like it's also really good, especially if you're not starting out with a ton of capital, because you can negotiate towards less down payment or something like that, as long as the numbers work out for paying it off to the seller by getting the rent from the associate, whoever's living in the house. So that's definitely something I'm gonna look for. Did you find these deals from like a broker? Or were you sending out like direct mail, or is it just connections?
All of the above. So
Awesome.
yes, we've done everything. Yeah, so we've done everything. We've done direct to seller communication, letters, postcards, cold calls. We've talked to wholesalers. We know the wholesalers in our area. They know that we buy. They send us deals. We have connections, obviously, in the real estate brokerage industry with all the different agents that we work with on the other side of the table. So they all know, we've talked to all of them about, hey, if you got a pocket listing, if you know a seller who's looking to sell, we'll still pay your commission. Bring it to us first, and we'll buy the deal. Make it a win-win-win. Your client gets the price they want, you get your commission without doing much work, and we get the deal that we want. So like all those things we've done and continue to do. And I think any avenue you can explore and find to get you the deal that you want is the way to go. So you want to try them all and see what works in your market with the deals that you have in that market.
Yes, sir. That's exactly what I was thinking. It really that one really kind of hit home with me, just because I feel like it's geared a lot more towards. I mean, obviously, if you're at a higher level, but I feel like it's also geared towards someone who's just starting out. If you get the right deal, because I feel like you could definitely get into it without having to go through all these bank loans and stuff like that. And if you have a good way to get in, like these guys said, it took them 6 months of cold calling these brokerages to actually
Yeah.
finally get a deal. And having an in with
Yeah.
a broker, I think is a big star. I think that really like hit home with me, that type of financing and getting deals. So your insight on that's really beneficial. I'm really looking forward to doing deals like that. Really, the last thing I was going to ask you is if you had any good books that you've read, and like just anything that you've learned to get information, like where you've gone. I'm listening to a lot of, obviously, the bigger pockets. Got a couple of books coming in. I've just
Yep.
figured out about the guy Pace Morby. He's done a lot of the seller financing
Yep.
stuff, and so I'm watching a lot of his
Hmm.
stuff to see what he has to
Hmm.
say. But if you have any books or stuff like that that you suggest, I'm open ears.
Yeah. Tell me which ones have you read so far?
I've read The Millionaire Real Estate Investor. I just finished that one. I really, really like that. I've read ABCs of Real Estate Investing, and then I read the How to Invest in Real Estate by Bigger Pockets, which was a really, really general overview. I've got Rich Dad Poor Dad coming in the mail on Wednesday,
Yep. Yep.
which I'm really looking forward to reading. I've heard a ton of good stuff about that.
Absolutely.
And then I've got mostly just books. I have some like I have like a multifamily book from Bigger Pockets. I've got a house hacking book. I've got some management books, how to start with low money, like wealth without cash, stuff like that. I've got like a whole Amazon list for like 30 books. So
Right. So let me show you some that I've read. In fact, I don't know if I have them. Yeah, I do. Hang on a second. I'll pull them right off the shelf here. Hold on. All right. So you mentioned Rich Dad Poor Dad. So that's an awesome book. This one is broad, not necessarily specific to real estate. It's got real estate references and things that he suggests, but it's also like a good business book and money book. It's really good for figuring out how money works and how to make money. Right. This one is one of the original ones that Brandon Turner did. He published that with Bigger Pockets. And this is the book on investing with real estate with no or low money down. It's got a lot of different strategies for how to do that. A lot of the stuff that we talked about on this call today is in this book. Again, it's sort of more of an overview, and he doesn't go deep into a lot of these strategies or all of them, but there's a, it's a pretty good starting point there. Then the next one by Brandon Turner that I read, this was really, really instrumental for me in learning how to manage rental properties, how to buy rental properties, what's involved, financing, all that stuff. Again, another one by Brandon Turner. You might be seeing a theme. I really think that the guy really knows his stuff, and his story is transformational. Obviously, you've seen him on a ton of podcasts.
Mhm.
He left the Bigger Pockets podcast a while ago. He's got his own podcast and stuff he's doing. He's still affiliated with Bigger Pockets, but this is an awesome book to read for a brand new rental property owner and investor. So that's a good one. Another one is this is the follow up. It's almost like volume 2 to that
Okay.
first one, the rental property investing. This one is on managing, how to manage them. And even though these books are now, I don't even know, probably like close to 10 years old, 9, 10 years old, I think they're still very, very applicable today. Yeah, this was 2000, published in 2015, so 9 years old, right? But I think it's very applicable to almost everything in this book is still the right thing, still the right
Hmm.
advice for how to handle it. And so that one is really good. This one is by Chad Carson. It's called Retire Early with Real Estate. This is another really good book. Chad was a guest on my podcast a couple of years ago. I've kept in touch with him. He's, again, someone affiliated with Bigger Pockets. He actually just came out with a new book. You might want to check that out as well. But I would start with this one because this is one of his like first original books. He goes through a lot of different strategies, numbers, like all that stuff. It's all excellent stuff. And then another one that I found really interesting, and this was more like for house hacking and starting out with how to save money, how to get into house hacking set for life by Scott Trench. Really good book as well. So that's something that you might want to look into. So they're just, and there are other books I don't have in hard copy that I've purchased from Bigger Pockets. But if you read just these books right here, you're golden, man. You'd be so far ahead of almost everyone. The main thing I would say with reading books and learning, and I think you should absolutely read all these books and even more than that, don't allow the reading and learning to take over the doing, because you still need to invest in real estate and need to actually apply what you're learning in theory, apply it to practice. Because if you don't do that, and so many people on Bigger Pockets that I come across, and even in local meetup groups, they talk a lot about real estate. They know a lot about real estate theory, but they haven't done a single thing,
Hmm.
and they don't know how reality works. Theory is great, and these guys have all done it in reality, and they try to convey their experience from reality to theory. It's not the same as doing it yourself. So you're never going to have all the answers. You're never going to get all the answers from a book or a podcast or a video or even a coaching call. None of that is going to compare to actually getting into it and doing it, because there's always going to be different variables that you didn't expect, didn't anticipate, different situations. And the only way you can learn and get that experience is by actually doing. So I encourage you to read everything you can and learn as much as you can, but don't let that interfere with you doing it. Because even if you read 3 books and you've gone on these different phone calls and had meetings and posted in the forums, I think you're ready enough. You have enough knowledge and information that as long as you can get your financing and the situation is right, you should go ahead and buy the property and then work from there. And you can continue learning while you're also in the deal and managing it and investing.
Yes, sir. That's great advice. I actually, this book just came in yesterday. I have
There you go.
Set for Life as well, so
Nice.
I'm looking forward to reading this one. And Rich Dad Poor Dad's coming in soon too. But I definitely agree with that. A lot of people are saying that everybody reads books and all this stuff, but it was like 80% of people like talk about it, but only like 20% of people actually end up doing it.
Exactly.
So
Exactly. Yeah. The 80
um,
20 80/20 principle applies there too.
yeah,
The
and
Pareto
so
principle.
that's definitely my goal. Being 18, hopefully getting this year being like, even if I like really taking this year to learn everything so that I don't have any excuses to not do it once I'm in college. So I think that this has been amazing. I really really appreciate you taking the time out of your day. I know your time's super
Yeah.
valuable to just talk to me and answer my questions. It really means a lot.
I really appreciate you coming on. I think, like I said, I think this will be an awesome video for people that subscribe to my YouTube channel, people that follow me. And you've asked a lot of really good questions that prompted a lot of good conversation. I think this is going to be really beneficial for everyone. So I thank you for jumping on and having the courage to do that. I know it can be a little bit nerve
I
wracking if
was
you
really
haven't done it before.
nervous.
Yeah, no, you did great.
Yeah, so just thank you so much. It really means a lot. I really, really, really appreciate it.
You got it, man. Yeah, if you have any other questions or anything else, obviously reach out. And the other thing I would suggest to you, I'll send you a link. Subscribe or follow to my school.com private group. There's no fees. It's completely free, but it's something that I'm specifically focusing on building this year. And the focus of that group is on house hacking. So if you're interested in house hacking, you think that's going to be most likely the way you go for your first few properties, take a look at that. I'll send you the link, and I'll put a link for everyone who's watching who might be interested in checking it out in the description of this video when I post it. But I hope to see you there. And if you have any other questions, let me know.
Thank you so much. Yeah, I'll definitely go into that. Thank you.